Joining us now is Mona Mahajan, Edward Jones Senior Investment Strategist, and Samir Samana, Wells Fargo Investment Institute Senior Global Market Strategist. Guys, welcome to the show. Samir, I'll start with you. We closed at 45.55 on the S&P 500. A number of traders noting that 45.50 is really this technical level of key resistance. Want to get your thoughts on the rally and whether it continues to have legs here.
Sure. We saw those levels last spring, and that didn't turn out too well. I mean, what we would say is, look, one, we're not surprised at all. You just have these episodes where things kind of align for the markets, either to the upside or to the downside. So this would be one of these overshoots. Our year-end target range is 4,000 to 4,200. So this is, kind of a visit to the upper end of the range. Just recently, whether it's March of this year or October of last year, we were below the range. So I think, probably the next move lower is going to kind of probably transpire into the end of the year. And so it's probably a pretty good idea for investors to kind of, act accordingly, right? Go ahead and rebalance those portfolios, maybe get a little bit higher up in market cap, higher up in quality, because we probably will see kind of the inverse of this into the second half.
Mona, do you see it the same way, especially when you do have the soft landing consensus taking shape, including among some of the bigger bears on Wall Street in recent months, disinflation traction, peak Fed expectations, and oh, by the way, so far, some better than expected earnings reports from some of the biggest names so far?
Yeah, absolutely. Look, we actually think there's a little bit of a more bullish case to be made here. In fact, it's a triple whammy, as you alluded to. We not only got the better inflation data last week, that's coming even as the economy is holding up. And in fact, there was a bit of nerves heading into earnings season, but thus far in its early days, 7.5% of the S&P 500 has reported. Amongst those, 84% have beaten, and in fact, they've beaten by 8% or so. So coming into the quarter, we were looking at about negative 7% earnings growth. We're now looking at about negative 4%. Now, we still have some ways to go, but the good news is earnings revisions are moving higher. We think that could drive market returns as well. Now, keep in mind, we would be cautious on extrapolating, the 17% return we've seen year to date to a straight line higher in the second half. Of course, bouts of volatility are normal, are probably likely, but keep in mind there's a lot of money sitting in CDs right now. Over the next 6 to 12 months, as that CD money comes due, there's some reinvestment risk there. Do they want to take a lower rate of return reinvesting in CDs, or think about the markets which have returned much higher thus far than that 5% that they could be getting in cash-like instruments? So I do think there is some momentum behind markets and then some catalysts that we could see down the road as well.
Samir, what should investors be doing with that CD money or maybe some of that equity money that they should be reallocating? I mean, fixed income, longer dated, what?
Yeah, so we would be using a little bit of a barbell on the short end and on the longer end. We like the fact that the Fed's probably going to continue to raise rates here. Again, inflation is not under control in our opinion. If anything, this 3% print that you just got was largely built off of base effects. Remember, oil was about $120 in June of last year, so that makes the comps very easy. But we would also be locking in kind of the long end, especially at rates above 4%. We think once inflation does get under control, those 4% plus yields will look pretty good in that type of inflation environment.
Mona, let's talk about the financials. I mean, we talk a lot about the big banks, but I can't help but notice today the KRE, the regionals, closed up 4.25% back at levels from late March. They've been stubbornly below there for all this time. Is that a read-through on the bigger bank earnings? Is this still worth playing as we continue to get more regional bank numbers, tomorrow and through the next several days?
Yeah, we think this talks to a bigger theme of the broadening of market participation. So that's one area that we are seeing some interest in going forward, and we think that could be a theme throughout the second half of the year and into 2024. The market may not be led by just a narrow set of technology, AI-based companies, but we could get some broadening into cyclical sectors like financials. Now, to your point on the regionals, it is interesting. The big bank readings we've gotten so far have indicated that, one, the higher yields have helped. Despite the inverted yield curves, they are seeing better net income margins. Net income interest margins. And secondly, there is this opportunity that we see in front of large banks and even some of the regional banks in that the IPO market and capital markets broadly may start coming back if you think about the next 6, 12, 18 months. It's really been quiet in terms of capital market activity, M&A, IPOs, et cetera. There is a real catalyst there that we may start seeing more activity there that benefits largely the large banks that have exposure, but also certain regional banks that can take advantage of supporting M&A deals in particular. So we certainly think that there are opportunities to get involved in the banking and financial sector. And thus far, the yield environment has actually been a positive rather than a negative.